G'day folks, welcome to the weekly general update for the 19th and 20th of May. Just a reminder on the general advice nature of this information. So summary of the action for the week, which was obviously a big one to the downside, one of the most dramatic weeks we've had in quite some time since the fairly sharp moves we saw back in 2011, and it resulted in the S&P falling by 58 points in the end, which is a big move. The key levels, 1340 broke, 1322 broke, and it's now down, basically sitting on the next important level, which we'll have a look at in a minute, 1290, and that obviously needs to hold, otherwise we could see some real panic selling if that doesn't hold in the next couple of days. There was a little bit of panic selling evident, certainly in our market on both Wednesday and particularly on Friday. I really had the distinct feeling that Friday was very overdone. Given the US market was down on Friday night, I would expect our market will open weaker on Monday morning, but I wouldn't be surprised to see it turn around in the first hour or so. What's behind all this? Obviously it's concerns over Greece and the potential domino effect, but I'm really seeing some very conflicting data over this, and I've got a feeling that this stock market reaction is way overdone. We're not seeing the same level of fear and panic in the bond market and the currency market, and also in things like the VIX index as well. So I think this stock market sell-off has been considerably overdone. The VXO, we'll have a look at that, but it's rising, but we're still well below the 30 mark that we saw during 2010 and 11. So there's not the level of fear in the market that we've seen on previous sell-offs. Now our market was horrible, as it often is, lost 240 points on the week, and also our banking index cracked last week as well. It had been holding things together, but it actually performed worse than the materials index did. It was selling across the board. There was no sector that was spared last week, and even the high quality stocks were sold off. But some of them now are very cheap, and whilst the price could move lower, they really are getting down into an attractive buy zone. So looking to buy some of the highest quality stocks on our market at very attractive prices. And as I said, I really wouldn't be surprised if on Monday or Tuesday we see some sort of relief rally starting. Just a couple of comments in general. Sentiment at the moment, and this is in the US, sentiment is running at about 24% bullish, and that's an incredibly low level. The normal average level of bullishness is around about 40%. 24 is the kind of level where you see significant market bottoms. I'm not saying that's going to happen, but we're down in that kind of level. Only 12% of New York Stock Exchange listed stocks are trading above their 50-day moving average. So that is a similar kind of situation to what we saw around the lows in August of 2011 when we had that mini crash. So they really are at incredibly low levels. There's a couple of momentum oscillators. They're at levels we've not seen since the mini crashes we had in 2010 and 2011. Yet all of this is happening while the credit bond spreads are relatively calm. And as I said, the VIX index is relatively calm. Yes, it's moved up, but it's not at the extreme levels that we would normally associate with the data that I just went through. So for me, everything is in place for a sharp rebound. The question now is it sustainable? And I guess the answer to that is probably only if central banks come in with some more money printing, and I think that's always going to be the wild card. So let's have a look at the S&P index first of all. You can see I've got a couple of Fibonacci scales here. One of them is coming off the low point we had in November, and the previous one was the low point, which was October of last year. You can see 1340 was a level that broke. 1322 was an important level that broke. We're now down here at this 1290 level, which lines two of these retracement levels up. So 1290 is pretty important. You can see on the RSI the S&P is considerably oversold now, so a sharp move back up would not be at all unusual. If 1290 breaks, then you're looking at basically 1260 or 1248 are the potential areas of support. Now, apart from the fact that we've got two Fibonacci levels lining up here, we've also got quite a significant peak, which was October 27th of last year, also providing support. So this level here at 1290 is very important, no two ways about that. So that will really be the key to see what the market action is around that level. If we close below 1285, then I think it kills the scenario that this is just an ABC correction. I must admit I've had my view changed quite a lot. I have been working on the basis that this would just be a normal ABC correction to the downside. Breaking through 1322 certainly weakened that position considerably, and it's still a possibility that this could be the low and we move higher from here back up towards the 1420 area. It's still possible, but the odds of that happening have really changed dramatically in the last week. But if we close below 1390, then I believe that we could well be into a bear market. So very, very important level. So we're at such a critical juncture. This is not a time for big bets. That's for sure. But it doesn't mean we can't more actively trade and make some money along the way. And we certainly had a great week last week. Now, looking at the ASX 200, you can see we had a false break here of this range that had been tested 9 or 10 times. It managed to break above it for a week or 10 days and then re-entered the range, which is a really, really good trading signal. Re-entering the range, that happened on the 7th of May, did so very decisively, and then we've had a very, very sharp move to the downside. Let's have a look at the finance index. Let's have a look at this on a weekly chart. This really tells a clearer story. You can see quite a sharp move in the finance index last week. And if we have a look at materials, also pretty big move there as well, and broke some key support which we were sitting on the week before, but last week really blew away that support. And we saw BHP and Rio obviously breaking their respective support levels as well. Now let's have a look at the whole bond market yield area. Spanish bond yields still up above 6%, which is not disaster territory, but it's certainly an uncomfortable area and it's not really sustainable in the long term. The Italian 10-year yields holding just under 6%, 5.81, also looking a bit shaky, but obviously most of the focus is on Spain at the moment. And I believe it's really central bank intervention which is going on under the table all the time, because we know that global money supply is growing at about 10% a year. So central banks certainly doing all sorts of things under the table, and I think that's probably what's holding the credit spreads down to a reasonable level, because credit spreads, in other words, the difference between the strongest and perceived riskiest sovereign debt, that blew out to something like 400 basis points during the GFC. It's less than 50 at the moment. So there is not the kind of level of panic in the bond credit spread market that we saw in 2008. And I think that's partly because the central banks are doing whatever they can to hold that down. It's interesting that the G4, the main four economy banks, central banks, have increased their balance sheets, in other words, printed money, in effect, by various means, by $6 trillion over the last 3 years. So it's just been quite a staggering event. And it's all that liquidity that's basically held stock markets up, held the banking system together. Now, if the ECB or the Fed moves overtly in terms of if the Fed comes out with QE3 or the ECB does something quite public and overt, then we're going to see stocks and commodities spike higher. I don't know if it's sustainable, but they will spike very sharply higher. US dollar reached a double top and then reversed on Friday night, so we'll have a look at that chart in just a minute. But we did see quite a big week for gold. Gold was dipped, but then recovered and recovered strongly enough to actually rise $14 on the week itself. It dipped below 1550 support, but as you'll see, we've had a couple of dips below that level before. So the move higher in gold could still well be on technically. Fundamentally, I believe it's absolutely justified. I believe fundamentally gold should be well above $1,800 an ounce. We also saw the Huey index, which is the main gold index that is watched around the world. It reversed off a pretty important support level on Friday night as well, or over the last couple of days actually. And gold stocks did make some reasonable recoveries, both in America and here. Oil was down $5 on the week. Brent crude is now down from nearly 130 down to 106. Light sweet crude got to about 110 from memory. It's now down to 91. So some fairly sharp moves in oil. Copper finished about $3.50. So yes, it's down below that 380 support level, but these are still highly profitable levels for the vast majority of copper producers. So it's really not indicating disaster territory yet. This is the 6-month copper chart. You can see we certainly have had a sharp move in the last 5 or 6 weeks, but that's still quite a buoyant level. Let's have a look at some other charts now. So we'll look first of all at the US dollar index. So you can see we had a very, very sharp move as the euro moved down. We got to a double top on Thursday and we got a big reversal on Friday, which certainly helped gold. So at this stage I think it's just technical. We were way overbought on the dollar index, so getting a bit of a move down is just a normal technical reaction from that. Given that we've now got to sit through another 3 or 4 weeks before Greece has elections again, and then there'll probably be some more political turmoil coming out of those elections, it's pretty hard to see what's going to drive the euro higher. So therefore, I'm not really expecting the US dollar to come off very much in that period. Let's have a look at the HUI index. Key support level down here, which it bounced off during the week and started to reverse back up again. So hopefully that will hold and we'll get some kind of sustainable rally. It's just been a terrible, terrible period for gold stocks and really quite inexplicable. Let's have a look at gold itself. Look first of all on a weekly chart. You can see we had dips just below this important high, which was formed in April of last year. We had a dip just below that in September last year. We had another dip in the week of the 30th of December. We've just had another dip here, and you can see quite a nice reversal. So hopefully we'll see gold be able to sustain some upside from here. And I guess what the gold market is saying is that there's certainly an expectation rising that there's going to be more quantitative easing coming through. Just looked at on a daily chart, you can see we had a reversal on Wednesday and then 2 very strong finishes on Thursday and Friday night. It was well oversold and it's coming back quite strongly, so hopefully that gets sustained for us. So there's just one other chart I wanted to have a look at, and that was the VXO, the VIX index on the S&P 100. You can see we've had some really big spikes. You go back to the massive spikes obviously in 2008 when everybody thought the world's global financial system was falling apart. We had some more big spikes above 30 in the middle of 2011, some more big spikes in 2010 and 2011, and you can see that we're starting to move back up again, but it's nothing, absolutely nothing like what we saw over the last few years. So the VIX index is not really indicating disaster territory at this stage either. So just to wrap it up in terms of overall strategy, 1290 is important, very important support. Otherwise we're looking at 1248 and things could get a bit ugly. I'm expecting a relief rally this week, possibly as early as Monday morning. Aussie stocks, if you are short, you want to start taking some partial profit on the shorts. Don't wait for the turn, because the turn will be sharp when it comes. There's some good buying, but you certainly need to exercise some real care. You need to be crystal clear about what you're doing in this kind of market. It's a great market for traders who know what they're doing, but if you are not really clear about how you're going about things, then just be very, very careful. In fact, I wouldn't be in this market if you're not an experienced player or you haven't got someone who can guide you through it. I'll be looking to re-short sell the bounce. We will get a bounce, but I'll be looking to short into that again, obviously on selected stocks. And this really is not a time for big bets either way. Really be taking care in this market. So that's it for this week. Cheers.